Hello and welcome to Engineering Economy. This is Dr. Alec Amerdiner. Today we will talk about engineering costs and cost estimating. We will focus today on engineering costs, and then we'll continue the lecture next time on cost estimating and estimating models. We will discuss different types of costs that are all described here, including fixed and variable, direct and indirect, marginal and average, sunk costs and opportunity costs, recurring and non-recurring costs, incremental costs, cash and book, and also lifecycle costs. Next time, after this lecture and the next lecture, we will also talk about cost estimating, including cost indices, estimating benefits, and cash flow diagrams. The learning objectives for today is to understand various cost concepts. And we'll later also, not in this lecture, but in the next lecture, we'll also understand various cost estimation models. So that will be in the second part of this lecture. And using these models, we will be able to estimate engineering costs with various models. And also learn how to construct cash flow diagrams. So let's take a look at this example. So it's a North Slope natural gas pipeline. And so from Alaska North Slope, we want to transfer natural gas. And there is estimated 35 trillion cubic feet of reserve in terms of natural gas resource. And the US market, it has a demand of 18 trillion cubic feet by 2010. So as you see, it's a little bit outdated example, but nevertheless it's important to consider it. And the estimated consumption rate increases between 2 and 3% annually. So the project that we are considering or have considered is bringing Alaska North Slope natural gas to the United States. So it will have an estimated infrastructure cost of $20 billion and an estimated project duration of 9 years. So as you can see, it's quite a long project. And the design capacity is 4.5 billion cubic feet per day. So there are project alternatives. First alternative is we could have 2,140 miles of pipeline from Idaho to Chicago. And there's another alternative. So if we don't go with alternative 1, we can go with alternative 2, which is 800 miles of pipeline from Idaho to liquefaction plant, and then it's shipped on ocean-going tankers. So there are some questions to consider. What type of cost estimating should be utilized for this project? When the project is estimated to take between 5 and 10 years to complete, should cost estimates be adjusted for inflation, regulatory changes, and changes in economic environment? Should a large-scale project be required to meet the same rate of return requirements as smaller projects? Are there any ethical issues related to economics, the environment, safety, and other factors that should be considered? So, of course, we're not going to answer all of these questions, but it's important to look into this and understand that, especially dealing with a larger or longer projects, you need to be very careful in estimating costs. And so the first thing we're going to do is we're going to start understanding different cost concepts. And then, in the second part of this lecture, we'll talk about cost estimation. So what are the types of costs? There are many different types of costs. Of course, first comes to mind are two types of costs that are related to each other: fixed costs and variable costs. There are also other types of costs that are related to each other. For example, marginal costs versus average costs. And we will talk more about each of these types a little bit later in this lecture. So another two related types of costs are sunk costs and opportunity costs, recurring and non-recurring costs, incremental costs, cash costs and book costs, life cycle costs. So these are the important types of costs that we will discuss in this lecture. So let's talk about engineering costs, specifically fixed costs and variable costs, and try to understand how they differ from each other and how they relate to each other. So fixed costs are constant and unchanging, regardless of the level of activity over a feasible range of operations for capacity or capability available. But the variable costs, they're operating costs that vary in total with the quantity of output or other measures of activity level. So variable costs are dependent on the quantity of output or activity level, while fixed costs do not depend on these factors. They are constant and unchanging. Alright, so here's some examples of fixed costs and variable costs that hopefully will help you understand further these two concepts. So example of fixed costs: property taxes, insurance, right? So if we're doing some activity and we need to use a property in that activity, then we have to pay property taxes on that property, regardless of the level of activity or quantity of output. So property taxes and insurance are clear examples of fixed costs. Similarly, management and administrative salaries, because regardless of how much we produce or how active we are, we need the management and administrative personnel, and so we have to pay them salaries. Other examples of fixed costs are license fees and interest costs on board capital, rental or lease. Now let's talk about variable costs. Well, there are some examples of variable costs that are also very easy to notice. Example, direct labor cost. So direct labor costs, they're specifically connected to the amount of output, right? So it's directly related to the output that we will produce. That's why it's called direct labor costs. Direct materials. So we need to purchase specific amount of material to get specific output. So it's connected directly to the amount of output we're gonna have. If we don't have enough materials, we won't be able to produce the output that we require to have. Now let's talk about other type of costs, direct costs and indirect costs. And I already mentioned direct labor costs, right? So again, right, or direct material costs. So again, it's very important to understand what direct is. Direct costs are costs that can be reasonably measured and allocated to a specific output or work activity, while indirect or overhead costs are costs that is difficult to attribute or allocate to a specific output or work activity. So key question, where do the numbers come from that we use in engineering economic analysis? Cost estimating is necessary in an engineering economic analysis. When working in industry, you may need to consult with professional accountants to obtain such information. Now let's take a look at the important method that connects fixed and variable costs, and also help you establish when you're profitable versus when you're not. And this method is called break-even analysis. So break-even analysis uses total variable costs, and that basically found using this equation where we have a product of unit variable cost multiplied by the quantity. And so it can be written as TVC, which stands for total variable cost, right? And then VC, meaning variable cost, which means what are the unit variable cost, and then Q is the quantity. So similarly, we can have total cost computed. Total cost not only include total variable cost, but also the fixed cost. So we have fixed cost plus total variable cost. So total cost would be fixed cost, FC, plus VC multiplied by Q, right? Because that's our total variable cost. And similarly, we can get the total revenue, and total revenue is unit selling price multiplied by the quantity. Therefore, we can abbreviate it as SP for selling price, meaning unit selling price multiplied by the quantity. So again, right, these are the equations that are used in break-even analysis. So now let's go ahead and use it. But before we do that, let's also discuss what are we trying to find. What we are trying to find in break-even analysis is we are trying to find break-even point. And this point is the output level at which total revenue is equal to total cost. So the way to find it is simply by equating the total cost here to the total revenue. So when total cost equals to total revenue, we're gonna get the break-even point from that. So notice break-even point is instead of Q, right? So this is the total revenue at the break-even point, right? The quantity being the break-even point. So BEP stands for break-even points. Instead of Q, we put break-even point here. So again, right, we're plugging in both for total revenue, we're plugging in BEP as Q, and for total cost, we're plugging in BEP as Q. And so then again, right, after simplifying, right, and moving this to the left, from the right hand side to the left hand side, right, combining together, we establish this BEP is just fixed cost divided by the difference between the selling price per unit and the variable cost per unit. All right, what are the applications of break-even analysis? Well, we can use it to determine minimum production quantity and also forecast production profit or loss. So here's a graph that helps you understand that. So let's say we have this production quantity as our x-axis, and then the amount of money in US dollars as the vertical axis, y-axis. So here would be our fixed cost. As you can see, they don't depend on production quantity, so they just constant, right? So this is a constant line. And based on break-even analysis formulas that we have this linear variable cost, right? So we have linear variable cost. Of course, this is just purely variable cost without the fixed cost. To get the total cost, as you remember, we need to add these two, the fixed cost and the variable cost. And so now, right, what we're gonna do is basically lift that at every point. We're lifting it by exact amount that we have here for fixed cost. So, right, this variable cost here, it now will be translated up by the amount of fixed cost. So we'll get this total cost here. So now this is the total cost. Notice we also have the total revenue. We talked about it, and with our formula that we have, it's basically linear in terms of production quantity. So you'll get this total revenue as, again, linear, right? That starts 0, because when we don't produce anything, we're gonna get 0 revenue from that. And so notice that total cost intersect with total revenue, right? This line here, the magenta line, is intersecting with the blue line of total revenue. And so now what we're gonna get is we're gonna get this point, intersection point, and that point is the break-even point. So thinking about it, right, in this area we have total cost exceeding the revenues. So is it a profit or a loss? Of course, when costs are exceeding revenues, that's a loss. And in this area, our total revenue is exceeding the cost. So yes, that's our profit area. So this figure illustrates the break-even analysis, and it's very useful in terms of interpreting the outcomes of break-even analysis. So now let's take a look at the example. So let's say we have fixed cost of $225 and we have some variable cost of 20 per unit, right? So 20 times X, where X is our number of customers. And we also have the revenues, right? Of course, adding these two together, variable cost and fixed cost, we get the total cost here. And then the revenues are 35, right? Our selling price is 35 per customer, and we have X customers, so this is our total revenue. So where's our break-even point? This is our break-even point, right? So we break even at 15 customers. So if we have less than 15 customers, we're going to have a loss. If you have more than 15 customers, we're going to have a profit. And if we have exactly 15 customers, we're at break-even point, which means we don't have either loss or profit. We're breaking even. So now let's talk about marginal cost and average cost. Marginal costs are the variable cost for one more unit of output, and they're useful when we have capacity planning. Example, let's say we have excess capacity, how much we're going to charge for that, right? What is the lowest price we can charge for or selling price for that excess capacity? Or we have basis for last minute prices. We can use the last minute pricing to sell off whatever we have in terms of marginal costs. And then average costs are total cost divided by the total number of units produced, and this is a basis for normal pricing. So here's an example, a charter bus venture. So Alberto plans to charter a bus to take people to see a wrestling match show in El Paso. His wealthy uncle will reimburse him for his personal time, so his time cost can be ignored. So we have the following costs. We have the bus rental, gas expense, other fuel costs, bus driver, and these are the costs. So you can see when we add them together, they add up to $225. And then we have the tickets and refreshments, each costing respectively. Ticket is $12.50 and refreshments are $7.50. So if we added these, they add up to $20. So the question is, which of the above are fixed and which are variable costs? Yes, of course, the costs on the left are the fixed costs, and the costs on the right are the variable costs. Great. So how do we compute Alberto's total cost if he takes n people to El Paso? What would be the equation? Of course, it's 225 plus 20 times n. So this is our total cost for Alberto. So we can graph the total cost, and this is our total cost. So marginal cost is the cost to take one more person, and the average cost are the cost per person. So the average cost is total cost divided by n. So the average cost is this. So if we plot this, we would get the average cost, and these are marginal costs, right? And they are actually, that's how we can establish the trip ticket, right? So let's look at, say, number 30, right? So we want to take 30 people with us, and the total cost is going to be 885. So the average cost is 885 divided by 30, which is $29.50. So total cost cannot be calculated from average cost value. For 35 people, right, if we want to take additional 5 people, we can multiply 35 by 29.50. That would not be correct. Instead, we need to use this formula for total cost, which would be 225 plus 20 multiplied by 35. So suppose Alberto ticket cost drops to $10 per person if he brings 20 or more people. What is the total cost equation? What is the total cost if the number of people exceed capacity of the bus? And bus capacity is 40 people. What is the marginal cost in this case? Of course, if we exceed one bus, then we cannot be taking more people without getting another bus. So that way we actually increase our fixed costs, right? If we do take on taking those people as well. Do we have enough information yet to decide how much money Alberto will make on his venture? What else must we know? You're right, we need to know the selling price of how much he's going to sell the tickets, his trip. So now Alberto needs to know his total revenue. Alberto knows that similar adventures in the past have charged $35 per person. So that is what he decides to charge. So total revenue is 35 multiplied by n, where n is the number of people. So total profit would be total revenue minus total cost. And so we have 35n as our revenue, and this is our total cost. So subtracting these, we're gonna have, right, this is gonna be negative now, minus 20. So 35n minus 20n is gonna be 15n. And then this again is also gonna be negative, so we get 15n minus 225. So that is our total profit. So total profit, right, from that as well, we can find the break-even point. So if we plot the total profit, notice, right, this is our costs in yellow, magenta is the revenue, and this is our profit. So you can see it starts at first below zero, where he loses the money until, right, he reaches the break-even point, and then he starts getting profit, right, because before it's a loss, as you can see. So how many people does Alberto needs to break even, so not to lose money on this venture? Again, we can just set the total profit to 0, and from that we establish n equals 15, right, because you just divide 225 by n. So he needs more than 15 people to make money. Again, where's the loss region? We can see this is a loss region where he's taking less than 15 people. And where's the profit region? That's a profit region where he takes more than 15 people. And where's the break-even point? The break-even point is at 15. So again, can you make this chart in Excel? Now let's talk about sunk costs and opportunity costs. Sunk costs are costs that has occurred in the past and has no relevance to estimates of future costs and revenues related to an alternative. Example could be purchasing price of car and equipment in deciding about the new equipment, except of course capital gain or loss considerations, but that will be discussed later, much later. So opportunity costs is another cost, right, that is not really technically included in the estimation all the time. So that's a cost of foregone opportunity and is hidden or implied. An example is existing equipment in replacement analysis. So let's talk about sunk cost. Sunk cost is the money already spent due to a past decision. As an engineering economist, we deal with present and future opportunities. We must be careful not to be influenced by the past. Therefore, you should disregard sunk cost in engineering economic analysis. Example, suppose that 3 years ago your parents bought you a laptop PC for $2,000. How likely is it that you can sell it today for what it cost? Suppose you can sell the laptop today for $400. does 2,000 purchase cost have any effect on the selling price today? So of course, as I said, 2,000 is an example of a sunk cost. It has no influence on present opportunity to sell the laptop for 400. So now let's talk about opportunity cost. An opportunity cost is a benefit that is foregone by engaging in a business resource in the chosen activity instead of engaging that same resource in a foregone activity. Here is a simple example. Suppose your wealthy uncle gives you $75,000 when you graduate from high school. It's enough to put you through college. 5 years of college at $15,000 per year. It's also enough for you to open a business, making web pages for small companies instead of going to college. You estimate you would make $20,000 per year with this business. If you decide to go to college, you give up the opportunity to make $20,000 per year. Your opportunity cost is $20,000. And total cost per year would be $35,000. So now let's take a look at this example. We have a distributor that has a case of electric pumps. The pumps are unused but are 3 years old. They are becoming obsolete. Some pricing information is available as follows. Price for a case 3 years ago, and that's $7,000. So what are the type of cost that this price represents? Yes, you're right, that's sunk cost. We also have storage cost to date of $1,000. What type of cost that represents? Yes, this is sunk cost again. We also have list price today for a case of new and up-to-date pumps, which is $12,000. That is a tricky question. This price can be used to help determine what the lot is worth today. An amount buyer offered for the case 2 years ago, $5,000. So this is actually an example of foregone opportunity. That was a foregone opportunity. A case can currently be sold for $3,000. And that's actual market value today. Alright, great. Now let's talk about recurring and non-recurring costs. Recurring costs are repetitive and occur when a firm produces similar goods and services on a continuing basis. Example, office space rental. Let's say you might have to pay a yearly lease or monthly payments. So it's recurring every year or every month. Non-recurring cost. Non-repetitive, even though the total expenditure may be cumulative over a period of time. Typically involve developing or establishing capability or capacity to operate. Examples are purchase costs for real estate and the construction costs of the plant. So now let's take a look at some or more specifically at what recurring costs are. So recurring costs are known, anticipated, and they occur at the regular intervals. They can be modeled as cash flows. Non-recurring costs are one of a kind and occur at irregular intervals. Difficult to plan for or anticipate. Example, you decide to landscape a lot of ground and then care for it, which are recurring and which are non-recurring costs you incur. Removing existing trees and vegetation. So that's a non-recurring cost. Have land graded with bulldozer. That's again a non-recurring cost. Have yard planted with grass. That's another example, a non-recurring cost. Plant shrubs and trees. That's also non-recurring cost. Mow grass. Well, you will do it periodically, so that's example of recurring cost. Fertilize grass and shrubs. Again, you'll do it periodically at regular intervals. That's recurring cost. Water grass and shrubs. Again, you do it periodically at regular intervals. So that's recurring cost. Alright, Next, we want to talk about incremental costs. And we'll talk even more about it in later chapters. So incremental costs are different costs between two alternatives. Suppose that A and B are mutually exclusive alternatives, which means that you can only engage in either A or B. You can't do both. If A has initial cost of 10,000 while B has initial cost of 14,000, then the incremental cost of B minus A is 14 minus 10, which is 4,000. Alright, let's talk more about incremental cost. Incremental cost is an additional cost that results from increasing the output of a system by one or more units or selecting one alternative over another. Example 2.3. Philip can choose between Model A or Model B. The following information is available. Cost of the item, purchase price for Model A is 10,000 versus for Model B is 17.5. Incremental cost of B is 17.5 minus 10, which is 7.5. Installation cost. For Model A, it's 3,500. For Model B, it's 5,000. Again, subtracting 5 from 5, 3.5, we get 1.5, which is an incremental cost of B. Annual maintenance cost is 2,500 for Model A and just 750 for Model B. So again, you subtract from a Model B cost. So 750, you're subtracting 2,500 for Model A. So we'll get a negative 1,750 per year in terms of annual maintenance costs. So you're actually saving, that represents a savings. The negative cost represents the savings. And then we have annual utility expense. Notice Model A, it's $1,200. For Model B, is 2,000. So 2,000 minus 1,200, we're gonna get $800 as incremental cost of B. Disposal cost after useful life. For Model A, it's 700. For Model B, it's 500. 500 minus 700, we get a negative 200, which represents savings. Alright, so we can conclude that Model B is more expensive than Model A, can we? Well, the answer is not so simple. It depends on the interest rate, right? So, and how long we're gonna use Model A and Model B. And that is because we will talk later about time value of money, right? Or actually we talked in the previous chapter 1, we talked a little bit about time value of money. And so just based on these estimates, we can really conclude which model is more expensive. And again, that's an intermediate type of problem that is just right for application of engineering economic analysis. Alright, so another tricky question was answered. Now let's take a look at different types of costs, cash versus book costs. Cash costs requires the cash transactions of dollars from one pocket to another. Basically, either you paying somebody or you're being paid. But the book costs, there are cost effects from past decisions that are recorded in the books, which means accounting books of a firm. So you can see that book costs not necessarily represent a cash transaction. It's just cost effects of past decisions. They do not represent cash flows. They're not included in engineering economic analysis. So keep in mind that we will only consider cash costs in engineering economic analysis. And one exception is for asset depreciation, right? So in that case, we actually will use the book cost, and that will be in much later chapters when we will discuss asset depreciation, and that is used for tax purposes. So here's an example of cash versus book cost. You might use Edmunds Used Car Guide to conclude the book value of your car is $6,000. The book value can be thought of as the book cost. If you actually sell the car to a friend for $5,500, then the cash cost to your friend is $5,500. Now let's talk about life cycle costs. Life cycle costs They're a summation of all costs, both recurring and non-recurring, related to a product, structure, system, or service during its lifespan. And life cycle begins with the identification of the economic needs or wants, which are the requirements, and ends with the retirement and disposal activities. So let's take a look in more detail on a life cycle. So products go through a life cycle just like people. Assessment and justification phase, conceptual or preliminary design phase, detailed design phase, production or construction phase, operational use phase, and then last but not least, decline and retirement phase. So all of these phases are life cycle of the product. So now if you look at this as this timeline, right, so from the beginning to the end of the product, we have these phases that we just talked about, right? We named them all. So for needs assessment and justification phase, we will consider the requirements. Here we also look at overall feasibility and do conceptual design planning. In the next phase of conceptual and preliminary design phase, we're going to do impact analysis, proof of concept, prototype, breadboard, development and testing, detailed design planning. In the third phase, which is detailed design phase, we'll do allocation of resources, detailed specifications, component supplier selection, production or construction phase. And so as we're moving to production and construction phase, here we do product, goods and services built, all supporting facilities built, operational use planning. And here when we continue to operational use phase, of course, we do the operational use of the product, we use the use by ultimate customer, maintenance and support, processes, materials and methods use, decline, and retirement planning. So we can see, right, that every time at the very end of each phase, we have the planning for the next phase. And so the last phase is decline and retirement phase. Here we have declining use, phase out, retirement, and responsible disposal. So now, important to realize how this life cycle differences or going through different phases, how it affects the costs, and specifically committed costs versus the spent costs. At the beginning of the life cycle, the committed costs, which are in bright blue, greatly exceed the cost spent, which are in black. And so you can see when we start defining the needs in this first phase, again, the life cycle costs are much greater in terms of committed costs, right? And only a little bit of costs are being spent. And also on the design, we're spending just a little bit, but we're committing a huge amount of costs later on. And then detailed design, it grows even larger. The committed costs are growing extremely large. In production, again, we have large costs, but also increasing the spend cost. During operational use, that's where it pretty much more even, where the life cycle of the cost spent are trying to catch up with the committed costs. And in decline, both the committed cost and the spend cost are equally large. So now if you look at this, right, important to see that the later design changes are made in the life cycle, the higher the cost. And decisions made early in the life cycle tend to lock in costs incurred later in the life cycle. Nearly 70 to 90% of all costs are set during the design phases, while only 10 to 30% of cumulative life cycle costs have been spent. So question to you, when is the best time to consider all life cycle effects and make design changes? Of course, earlier in design, earlier in life cycle, that's when we want to consider all life cycle effects as early as possible. Bottom line, engineers should consider all life cycle costs when designing products and the systems that produce them. or use them. So now let's talk about cumulative life cycle cost, committed versus spent. So you already saw what was happening. So if we accumulate them, right, then this is what we will see. Very early on, starting even with needs assessment and conceptual design, we have a large of life cycle cost committed, large percentage. While in terms of the spent, right, this is our life cycle cost spent. They're really, really low at the beginning. So again, very important to think things through as early as possible and consider any changes in the design early on, so less of the life cycle costs have been committed. So now cost ease of design changes in product life cycle. That's the ease of design changes. So at the beginning, the ease of design changes is very, very easy, right? It will be very easy to change something, but later, as we accumulated those additional commitment, it's not so easy to change the. And so you can see that when we are in production or construction, it dramatically makes it harder to do change in the design, and pretty much almost impossible in terms of changing anything during decline and retirement phase. And this is the cost of design changes, right? The costs are the opposite, the direct opposite of it. It's much smaller. The cost of design changes is much smaller at the beginning phases and much higher during later phases, including decline and retirement. So next time we'll talk about cost estimating, and this concludes the first part A of this lecture.